Navigating the delicate balance between inflation and employment has always been a challenge for central bankers. But Fed Chair Jerome Powell is now at the center of what could be one of his most defining moments. As he prepares to deliver his much-anticipated speech at the annual Jackson Hole Economic Symposium on Friday, Powell finds himself caught in a tug-of-war between two critical priorities: combating rising prices and safeguarding the job market. This dilemma underscores the complexities of monetary policy in an era where economic signals are mixed, and the stakes are incredibly high. But here's where it gets controversial. How Powell frames his next steps may not only shape the U.S. economy, but also ignite debates about whether data dependency is truly the best approach. Powell first used the Jackson Hole stage in 2022 to signal an aggressive stance against inflation, echoing the legacy of former Fed Chair Paul Volcker, who famously prioritized price stability, even at the expense of short-term economic pain. Last year, however, Powell shifted gears, focusing instead on supporting the labor market as unemployment figures showed signs of creeping upward. Now, standing before colleagues, policymakers, and global investors with just months left in his term, Powell must reconcile these dual mandates amid conflicting data that complicates his decision-making process. On one side, there's growing concern about inflation showing resilience. On the other, fears of a weakening job market loom large. And this is the part most people miss. The tension isn't just about choosing one over the other. It's about communicating effectively while navigating uncertainty. Adding another layer of complexity, external pressures abound. The Trump administration, along with many investors, expects interest rate cuts at the Federal Reserve's September meeting, regardless of the economic indicators. Yet, as history shows, rushing into such decisions without clear evidence can backfire. Former Fed Vice Chair Richard Clarida, now serving as a global economic advisor for PIMCO, emphasized this point. The Powell I know wants to be data-dependent and not make a decision until absolutely necessary. However, if rates are indeed lowered, the messaging becomes crucial. Will this be a one-time adjustment? A cautious step toward further easing? Or the beginning of a series of reductions designed to stimulate growth? Even if consensus emerges around cutting rates, articulating the rationale behind it could prove tricky and potentially divisive. The backdrop of Powell's final Jackson Hole appearance couldn't be more symbolic. Over the past 8 tumultuous years, he has steered the Fed through unprecedented challenges: a global pandemic that necessitated bold policy interventions, a subsequent surge in inflation, requiring record-breaking rate hikes, and relentless personal criticism from former President Donald Trump. Now, Powell faces calls to channel yet another iconic figure in Fed history, Alan Greenspan. Known for his forward-thinking approach during the 1990s, Greenspan often looked beyond immediate inflation risks, betting on productivity gains to stabilize prices. Could Powell adopt a similar mindset today, lowering the Fed's policy rate from its current range of 4.25% to 4.5%, closer to the so-called neutral level of 3%, which neither stimulates nor restrains the economy? Looking ahead, the inflation picture remains murky. Prices are still running about a percentage point above the Fed's 2% target, with some evidence suggesting they might climb higher. Yet, the Trump administration downplays the risk of sustained price increases, arguing that deregulation and anticipated productivity boosts will counterbalance any inflationary pressures. Treasury Secretary Scott Bessent recently highlighted this perspective, praising Greenspan's willingness to prioritize long-term trends over short-term fluctuations. Similarly, Fed Governor Christopher Waller, one of the names floated as a potential successor to Powell, has advocated for preemptive rate cuts to address perceived vulnerabilities in the labor market, contrasting with colleagues who prefer waiting for stronger confirmation of economic weakness. This divide among policymakers reflects broader questions about the Fed's data-driven philosophy. While relying on hard numbers helps avoid premature policy shifts, it also risks lagging behind real-time developments. For instance, recent revisions by the Bureau of Labor Statistics revealed a significant downward adjustment in job growth estimates for May and June, a development that bolstered Waller's argument for caution. With economic growth slowing to around 1%, some administration officials, including Besant, have noted inconsistencies in the Fed's actions. If the economy appears weaker than last September, when Powell promised robust support for the labor market with a 0.5 percentage point rate cut, why hesitate now? Amid these uncertainties, Richmond Fed President Thomas Barkin offered a glimmer of optimism last week, stating the fog is lifting. But it ultimately falls on Powell to clarify how much clarity has truly emerged and to chart the path forward. Will the Fed resume steady rate cuts, opt for a single cautious reduction, or continue waiting for additional data? Beyond the immediate debate, conditions have shifted since last year. Interest rates are already lower. Stock markets are thriving, and the unemployment rate remains stable. However, inflation, which had been trending downward monthly during previous rate cuts, has shown little improvement and even ticked up recently. Even Waller acknowledged the need for flexibility, noting that while slow growth justifies moving toward a neutral stance, misjudgments about inflation or job market weakness leave room to pause. As Powell takes the stage against the majestic Grand Teton Mountains, all eyes will be on him, not just for answers, but for leadership. So, what do you think? Is Powell right to remain tethered to data? Or should the Fed embrace a bolder, more intuitive approach? Share your thoughts in the comments below.